As an investor, it is very important to build a diversified portfolio with exposure in both equity and fixed income instruments. And when it comes to fixed income instruments, traditionally the most popular option is FD, that is fixed deposit. The biggest advantage with FD is fixed interest rate. So you know that by the end of a year, you will get a fixed amount of interest. That gives you a peace of mind. However, of late, the interest rate on FD have reduced drastically. Today, the interest rate on FD with top nationalized banks are in the range of 6%. And that's where I've been asked this question multiple times. What are the alternatives of FD? Hey everyone, my name is Sahil and this is my Personal Finance Academy. In this video, I'm going to cover 3 alternatives of FD that gives guaranteed return. Now, there are multiple debt mutual funds available in the market, but the problem is the returns are not fixed. And when you are looking for alternative of an FD, the idea is to invest in instruments that offers fixed return and instruments that are as safe as FD with a top nationalized bank. So I have identified 3 options that offers guaranteed return and are as safe as FD or even safer than FD. But before we proceed, I want to highlight the spam comments on my channel where a lot of spammers comment with my name and photo and share some numbers and email ID. I have already highlighted this in my previous videos as well. But in spite of that, I recently saw someone replying to it. Please don't make this mistake. I never share my contact details on comments. So kindly avoid replying to spams. By the way, I also have some shoutouts at the end of this video. So stay tuned. Alright, now let's get started with the video. So the first alternative of FD with guaranteed return is Gsec, that is government security. Now let us try to understand what exactly is this Gsec, what are the expected returns and how you can invest in them. So Gsec, that is government security, as the name suggests, is offered by Indian government. It is a bond that government offer against a fixed interest rate every year. Now there are 2 key terminologies that you should be aware. Government bonds with duration greater than 1 year are called Gsec, and with duration less than 1 year are called T-bills, that is treasury bills. As far as interest rates are concerned, the interest rates on Gsec and T-bills are not fixed. It means it would depend upon individual bond. There are 2 major factors that decide the interest rates on Gsec. First is the duration and second is overall interest rate scenario. As the duration of bond increases, the interest rate increases. For example, there are Gsec bonds with duration like 2 year, 5 year, 7 year, 10 year, up to 40 year. Yes, you can invest in Gsec bonds with duration up to 40 years where you get fixed interest every year. So higher the duration, higher would be the interest rate. It is up to you to decide what duration you want to invest for and accordingly you will fetch the interest rate. Then second factor that decides the interest rate on Gsec is the overall interest rate scenario in the economy. For example, currently Gsec bonds are available in the interest rate of 7 to 7.5% depending upon the duration. Now that is a very good interest rate, better than FD, which is currently offering interest rate in the range of 6%. Please note that once you buy the Gsec bond at a specific interest rate, your interest rate gets locked in. For example, if you invest in a 5-year Gsec bond with let's say 7.2% interest rate, then you will continue to fetch 7.2% interest every year for the next 5 years. Not only the Gsec bond interest is higher than FD, since Gsec bonds are offered from Indian government, there is a sovereign guarantee. That makes Gsec bonds even safer than FD. So you have a peaceful sleep. Although as far as taxation is concerned, interest earned on Gsec is considered income from other source and you have to pay tax on interest earned as per your income tax slab. So it is same as FD. However, if there is any appreciation in the bond price, then it is considered capital gain. So tax on long-term capital gain, that is investment duration of more than 3 years, is flat 10% or 20% with indexation benefit, and tax on short-term capital gain, that is duration with less than 3 years, is as per your applicable tax slab. Now the next question is how to invest and exit from Gsec bond. You can invest in Gsec bonds via any of the trading platform. You can just check your brokerage platform and they should have the option of investment in Gsec bond. For example, Zerodha offers this option of investment on its coin platform. Then there is a platform called RBI Retail Direct offered by Reserve Bank of India. It allows you to invest directly in central government bonds, state government bonds, treasury bills as well as sovereign gold bonds. It is a completely free platform. So there is no cost like brokerage fee, etc. there's only a payment gateway fee. So you can also consider creating a separate account on RBI Retail Direct. One thing that you should know is you can't invest in any bond at any time. These Gsec bonds and T-bills have a specific bidding window. So different Gsecs and T-bills would be available on different trading window. You can check the calendar to get the list of various Gsec bonds and T-bills of different duration and their bidding window period. And you can always exit your bonds even before the maturity by selling it on the secondary market. Considering the fact that currently the interest rates on Gsec bond is on higher side, it is a good time to invest in them. Now, second alternative is top rated corporate bonds. Just like government bonds, many corporate houses raise money via bonds and they offer a fixed interest rate against those bonds. This money is being raised by multiple reasons like your expansion of manufacturing capacity, mergers or acquisition, business expansion, etc. Again, the interest rate on these corporate bonds would vary from company to company. Now here you need to understand one very important point before investing in corporate bonds, and that is credit rating. Each company that offers the corporate bond has a credit rating associated with it. For example, one of the credit rating agencies is CRISIL, and it has highlighted a list of corporate rating for short-term as well as long-term loans. So AAA rated corporate houses signifies highest safety. That shows company is financially strong and has a very good history of debt repayment. Likewise, AA rating would show high safety, A rating would show adequate safety. And as the rating falls, the safety reduces. For example, a company with credit rating of C or D means there are high chance of default. Obviously, you don't want to buy bonds of such companies. Similarly, there are other credit rating agencies like ICRA, CARE, etc. with their own rating scale. Now, the interesting part is that the interest rate on corporate bond is directly linked with your credit rating of the company. It means if a company has higher credit rating, then it will offer lower interest rate. And a company with lower credit rating will offer higher interest rate. And that's where it gets very tricky. Now it is very tempting to invest in a corporate bond that offers 10 to 12% interest rate. But that comes with a higher risk, as such higher interest rates are offered by companies with lower credit rating. And corporates with AAA or AA rating would have lower interest rate in the range of 7 to 8%. That's why you need to be very careful with your investment. Ideally, you should only consider top rated corporate bonds with AAA or AA rating, or at max go for A rated bonds, because below that the default risk increases and you don't want to take that risk for additional 1 to 2% interest rate. Now if you look at the taxation part, interest earned from these corporate bonds is taxed as per your income tax slab. However, if there is an appreciation in the bond price, it will be taxed as per short-term capital gain or long-term capital gain, similar to Gsec bonds. As far as investment platforms are concerned, many brokerage firms provide the option to buy these corporate bonds. Otherwise, there are platforms like Golden Pie or Wintwealth that help you invest in these corporate bonds. Now, third alternative of FD is RBI floating rate saving bonds, also known as FRSB. As the name suggests, these bonds are issued by RBI on behalf of Government of India. These bonds have a fixed coupon rate which remains unchanged until maturity, but these bonds have a floating interest rates. So if you invest in RBI FRSB, keep in mind that the interest rate will change periodically. That's because the coupon rate on these bonds fluctuates based on the interest rate of its benchmark, which is National Savings Certificate. The interest rate for RBI saving bond is 35 basis point above NSE rate. As of today, the NSE rate is 6.8%. So rate on RBI floating rate bond will be 6.8% plus 0.35%, which is 7.15%. It means if you invest in RBI FRSB, you will fetch a guaranteed 7.15% interest rate today. Again, this interest rate is much better than the current FD rate, and there is also a sovereign guarantee. However, this interest rate is floating and would be reviewed periodically every 6 months and can change depending upon NSE rate. So if NSE interest rate increases, RBI FRSB interest will also increase, and if NSE interest rate fall, RBI FRSB rate will also fall. Currently, for the period between July 1, 22 to December 31, 22, the interest rate remains unchanged at 7.15%. As far as investment duration is concerned, these floating rate saving bonds from RBI have a lock-in period of 7 years. However, there is some relaxation for senior citizen. You can choose to opt for interest payment by the end of investment duration, that is 7 years, or interest can be paid on semi-annually basis. Now the question is how to invest in RBI FRSB. So you have multiple options to invest. You can invest via both offline and online platform of public sector banks as well as top private sector banks. For example, in ICICI Bank, there is an option to invest directly in RBI FRSB via its website as well as app. You can check with your respective bank on how to invest in RBI FRSB. Although the taxation on these bonds are again as per your income tax slab, which is similar to FD. So the three alternatives to fixed deposit include Gsec bond, top rated corporate bonds and RBI floating rate saving bonds. These are some of the options generally retail investors are not aware of, and all these three options are providing much better interest rate than FD, currently in the range of 7 to 7.5%. On the other side, the interest on FD with top public and private bank is around 6%. Now apart from these three options, you also have traditional post office schemes like your National Savings Certificate, currently available at 6.8% interest rate with a 5-year lock-in period. Then PPF has 7.1% interest rate with 15-year of lock-in period. The next option is Sukanya Samriddhi Yojana if you have a girl child. That is offering 7.6% interest rate, but again comes with a lock-in where the girl child attains the age of 18 years or past 10th standard. Then of course, you have Senior Citizen Savings Scheme for individuals above the age of 60 years that is offering 7.4% interest rate. Please note that some of these schemes have a limit on investment. For example, National Savings Certificate has no maximum limit, then PPF and Sukanya Samriddhi Yojana has a maximum investment limit of 1.5 lakh per year. And Senior Citizen Savings Scheme has a total investment limit of 15 lakh. Personally, I find the Gsec bonds very interesting as it is currently available at a very good interest rate and you can simply invest via your stockbroker without going through the hassle of opening new account. Now tell me in the comments, which is your preferred fixed investment option, and also let me know if you want me to create more of such videos. Now it is time for the shoutouts. So I have been receiving a lot of love and support for my hard work in presenting well-researched content. Of course, there are exceptions in comment. So I would like to highlight a few comments. First comment is from Raghavendra. He's saying, appreciate the crazy work and efforts that you put in. This is indeed giving us conviction and also believe that we are aligned as an investor. Well, thank you Raghavendra for validating my effort and ensuring that we are aligned as investor. Now next comment is from Preetham Tekriwal. He's saying, amazing video, lots of words to praise you. Best part was how you introduced every company in just few minutes. So thank you so much Preetham for your comment. Next we have got comment from V. Giresh and he's saying, dear Sahil, very good video, your explanation is very good. For an ordinary people also can learn and invest by watching your video. The next comment is from Samuel Joseph and he's saying, for the first time I am seeing such a great chart on every parameter of the company. Really amazing. Also your video coverage is fantastic. And then we have comment from Aryan Agarwal. He's saying, you always surprise me with your knowledge, you are amazing. There are many such comments and I wish I could include each one of them. But trust me, I always read your comments and your love and support is the biggest motivation behind my hard work. I hope I keep getting this love and support. Now final comment I want to take is a negative one. Although I know there will be always 1 or 2% people that will comment negatively, but I really want to clarify something. So the comment is from K.S. Kumar and he's saying that you are paid promotion. This comment was on my L&T technology video. Sometimes I get such comments here and there on my stock fundamental analysis. Let me clarify that none of my stock fundamental analysis videos are paid. None. I only try to cover the fundamentally strong companies. I don't promote any company for money. Hope it helps. So this is it for this video. I hope you'll find it useful, and if you find it useful, do share it with your friends. I'll see you in the next video. Till then, take care.